at exactly 9:47 a.m. Eastern Time on December 25th, 2025, the global financial machinery encountered a glitch that no algorithm was programmed to handle. In a high-rise office in New York City, a senior analyst at one of the world's largest bullion dealers refreshed his terminal for the fifth time. He was looking for the available physical silver inventory to update the holiday pricing. The screen did not show a low stock warning. It did not show a delayed shipping notice. It showed a simple chilling number, 0. By 10:15 a.m., this digital paralysis spread like a virus across the Atlantic. From the vaults of London to the trading desks in Zurich, the message became a synchronized chorus across every major retail and wholesale website. Out of stock, orders suspended, inventory depleted. For the first time in the history of modern capitalism, the silver market did not just experience a shortage. It experienced a total cardiac arrest on a day when the world was supposed to be at rest. The spot price at that precise moment sat at $71.94 per ounce. To the casual observer, this was a record high. To the professionals, it was a meaningless digital artifact. You cannot buy what does not exist, and at $71, physical silver had vanished from the face of the retail earth. This was the beginning of what we now call the 126 pivot. It was the moment the world realized that paper promises of wealth are a poor substitute for material truth. By the time this journey ends, you will understand why the next 7 days represent the most dangerous window in financial history, and why the transition from digital credits to physical reality is no longer a theory, but an accelerating landslide. To understand why the vaults ran dry on Christmas Day, we must first unmask the greatest illusion in the history of finance. The silver market is not a market of metal. It is a market of promises. For every 1 ounce of physical silver sitting in a regulated vault, there are over 200 paper claims circulating in the financial system. This is a leverage ratio of 200 to 1. In a functioning economy, this system of derivatives and futures contracts allows for liquidity and price stability. It operates on the assumption that not everyone will ask for their metal at the same time. It is a game of musical chairs where 200 people are dancing around a single seat. As long as the music plays, everyone feels wealthy. But in late 2025, the music did not just stop. The chair was removed from the room entirely. The COMEX in New York is the epicenter of this paper mirage. In the months leading up to the freeze, the registered inventory, the actual silver available to satisfy delivery demands, plummeted by 70% from its 2020 peak. We saw a massive exodus of metal. This was not a standard rotation of assets. This was a systematic withdrawal by institutions who realized that the paper price of $70 was a gift, a chance to exchange devaluing currency for a finite resource before the exit door slammed shut. When you have 200 claims on a single ounce and the owner of that ounce decides to take it home, the other 199 people are left holding nothing but a digital receipt. On December 25th, the world finally looked at those receipts and realized they were worth less than the ink used to trade them. The road to the Christmas freeze was paved with warnings that the mainstream media chose to ignore. To find the first real crack in the dam, we have to look back to November 28, 2025, Thanksgiving Day in the United States. While most of the country was focused on family and football, the New York silver market experienced a 10-hour server failure. The official explanation was a technical glitch in the clearinghouse infrastructure. But in a world of triple redundancy and hardened data centers, a 10-hour blackout during a delivery crisis is never an accident. Behind the scenes, the system was suffocating. 7,330 futures contracts had stood for physical delivery. In the language of the COMEX, that represents 36,650,000 ounces of silver. The bullion banks, acting as clearing members, looked at their rapidly emptying vaults and realized they reached a point of no return. They could not deliver the metal because the metal was not there. A secret intervention took place. Sources later confirmed that over $65 million in cash surcharges were paid to large contract holders to convince them to roll their positions forward to March. It was a massive bribe to keep the illusion alive for one more month. But this act of desperation only accelerated the panic among those who knew the truth. When a market leader pays you to not take delivery of the product you bought, they are telling you that the product is gone. From that moment on, the registered inventory at the COMEX became a countdown clock, ticking down to the final zero we saw on December 25th. While the West was busy patching a broken paper system, the East was executing a strategic cornering of the physical market. The most significant move came from India. For centuries, gold has been the primary store of wealth for Indian households. But when gold prices surged past $4,500 per ounce in early 2025, the middle class of the world's most populous nation made a rational pivot. They turned to silver. In a matter of weeks, hundreds of millions of people shifted their savings into silver coins and bars. This was not a speculative trade. This was a cultural tidal wave. The largest refineries in India ran out of stock for the first time in their history. But the real death blow to the Western supply chain came from Beijing. On January 1st, 2026, China is set to implement a total ban on the export of refined silver. China has recognized that silver is no longer just a precious metal. It is a strategic industrial grain. To power their 700-gigawatt solar initiative and their massive artificial intelligence data centers, China requires every ounce of silver they can produce or import. By cutting off the global supply, they have effectively removed 200 million ounces from the international market annually. This is a supply shock that no mining operation can fix in a decade. The world is now waking up to a reality where the East owns the material truth, while the West is left holding the paper promises. The global squeeze is no longer a possibility. It is the new foundation of the global economy. The instability of the silver market is merely a symptom of a much larger tectonic shift in the global financial architecture. On October 31st, 2025, the BRICS Alliance officially unveiled a new transactional instrument known as the unit. This is not just another digital currency. It is a direct challenge to the hegemony of the United States dollar. The unit is pegged to gold and backed by a basket of commodities, creating a system where value is anchored to the physical world rather than political decree. The technological backbone of this new system is the Cardano blockchain, chosen for its security and transparency. For the first time, nations in the global south can settle multi-billion-dollar trades in real time without touching the SWIFT network or the Federal Reserve System. But why does this matter for silver? Because when gold is remonetized as the foundation of global trade, silver regains its historical role as the essential monetary partner. In November 2025, we witnessed the largest state-to-state transfer of bullion in modern history. China purchased nearly $1 billion worth of gold and silver from Russia in a single bilateral trade. This metal did not go to an exchange. It went into sovereign vaults to back the unit. As central banks hoard silver to fortify their new currencies, they are permanently removing the float from the commercial market. The launch of the unit has created a black hole for silver supply, sucking in every available ounce to build a new world order where tangible assets are the only recognized form of power. We are now entering what professional traders call the Ghost Week. This is the 7-day window between Christmas and New Year's Day when the financial world typically falls into a slumber. The senior executives are at their vacation homes, the risk managers are offline, and the markets are left in the hands of skeleton crews and automated algorithms. In a normal year, this is a period of low volume and quiet consolidation. But in 2025, Ghost Week has become a powder keg with a lit fuse. The setup is unprecedented. We entered this week with physical silver inventories at all-time lows and a $5 price gap between the Shanghai Gold Exchange and the New York COMEX. This price disconnect is a fatal error in the global arbitrage machine. When the markets reopen on December 26th, the algorithms will attempt to close this gap. But in a thin market with no liquidity, there is no one on the other side of the trade to absorb the impact. We are facing the high probability of a flash event. When a wave of stop-loss orders is triggered, the price will not move in increments. It will jump. Because the dealers have frozen their sales, there is no physical metal to act as a tether to reality. We could see silver gap up from $72 to $85 or even $95 in a matter of seconds. This is the signature of a broken market, a moment where price discovery is replaced by price explosion. During Ghost Week, the screen will show numbers that seem impossible, but these numbers are simply the market's desperate attempt to find a price high enough to convince someone, anyone, to part with their physical metal. If Ghost Week is the spark, then January 1st, 2026 is the arrival of a global financial tsunami. Every year, the first week of January triggers a massive rebalancing of the global capital pool. Institutional investors, pension funds, and sovereign wealth funds manage over $100 trillion combined. These institutions operate under strict investment mandates that force them to allocate capital to the best performing assets of the previous year. In 2025, silver did not just perform well, it obliterated every other asset class. With a return of 126.3%, silver outperformed the S&P 500 by a factor of 7 to 1. It outperformed Bitcoin, it outperformed gold. When the fund managers return to their desks in January, they will be forced by their own charters to buy silver. This is not a matter of belief. It is a matter of mathematics and fiduciary duty. The problem is one of scale. If global pension funds attempt to move just 0.1% of their assets into silver, they will bring $50 billion of new demand to the market. To put that in perspective, the entire annual global mine production of silver is worth only $25 billion at current prices. We are looking at 2 years' worth of global production trying to squeeze into the market in a single month. There is no silver to meet this demand. The result will be a vertical price revaluation. The market will become a rationing mechanism, driving the price to $150, $200, or even $300, simply because that is the only way the math can balance. January will be the month when the institutional world realizes that being late to the silver market is the most expensive mistake in the history of finance. This brings us to the core of our story, the 126 pivot. Why has this specific number become the symbolic threshold for the new era? In the world of technical analysis and historical ratios, $126 represents the point where the old world ends and the new one begins. If we apply the historical gold to silver ratio of 35 to 1 to a gold price of $4,500, we arrive at exactly $128. The 126 pivot is the moment silver transitions from being a discarded industrial byproduct to being the ultimate monetary safe haven. It is the price at which the paper derivatives market officially dies. When silver crosses this line, it will be the signal that the 200 to 1 leverage ratio has collapsed. The world will no longer accept a digital promise. They will only accept the metal. If you are holding physical silver as you listen to this, you are holding the rarest form of collateral in the modern world. Your strategy for the coming months is simple. Do not be shaken by the noise. There will be flash crashes, there will be media blackouts, and there will be extreme volatility as the old system fights for its life. But remember the lesson of Christmas Day 2025. The price on your screen is a lie if you cannot use it to buy the metal. The real value is in what you can hold. We are moving from a debt-based monetary system to a commodity-backed reality. In this new era, silver is the king of the transition. The dealers stopped selling because they knew what was coming. The vaults are empty because the smart money has already moved. The 126 pivot is not just a target, it is the price of truth. Welcome to the new era of material reality. Hold your metal, watch the calendar, and prepare for the tsunami. Silver market crash, physical silver shortage, the 126 pivot, silver price forecast 2026, COMEX silver inventory, BRICS currency gold-backed, silver export ban China, precious metals investing, silver paper versus physical, gold to silver ratio 2025, global financial reset, bullion dealer freeze, central bank silver hoarding, Cardano blockchain finance, commodity-backed currency.